All right, let's jump right into this explainer. Today, we're taking a struggling turnaround play and running it straight through the gauntlet of history's greatest investors. We're acting as expert investment analysts today, unpacking a company that is quite literally fighting for its life. We're going to use the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some modern discounted cash flow models to perform a complete, rigorous stock analysis. You know, the stakes for our analysis are perfectly captured right here by a Peter Lynch-inspired idea. The golden rule of a turnaround is surviving long enough to actually see it. We're looking at a company trying to pivot its entire business model before the cash runs out. A comeback is a thrilling narrative, right? But the harsh reality of the market is that a story only matters if your balance sheet actually lets you reach the final chapter. So, here's our game plan. We've got a quick company snapshot. Then we'll view the stock through the lenses of Buffett, Lynch, and Graham, before building our own DCF valuation models and wrapping up with a final synthesis and verdict. Let's get to it. Part 1. The Company Snapshot. We're looking at 3D Systems Corporation, ticker symbol DDD. Right now, shares are sitting at around $2.91, with a market cap of about $428 million. They're a pioneer in 3D printing and digital manufacturing, but here is the absolute crucial context you need. They are smack in the middle of a massive restructuring. They've recently shed their non-core software units like Geomagic to go all in on specialized, high-margin healthcare and industrial manufacturing. But, and this is a big but, recent highly dilutive debt offerings hint that they're walking a very precarious financial tightrope. Moving on to part 2, the Buffett lens. If we step into Warren Buffett's shoes, we're hunting for a protective economic moat, competent management, and rock-solid earnings. So, how does DDD stack up? Well, the moat is pretty narrow. Industrial revenue is cyclical and actually dropped about 15%, though healthcare is incredibly sticky and growing at a stellar 21.3%. Management is cutting costs, sure, but their SEC filings openly admit to material weaknesses in internal controls. That is a massive red flag for Buffett. Earnings consistency, total failure. They posted a $4.4 million net loss in Q1 2026, which obviously drives a negative return on equity. Debt sits at $96 million against $85.1 million in cash, uncomfortably tight. And when we calculate approximate owner earnings using operating cash flow as a proxy, we're looking at negative $7.2 million. So what's the bottom line here? Because intrinsic value based on current owner earnings is zero, or even negative, Buffett would outright reject this stock. Without consistent positive cash flow, his buy price, factoring in any margin of safety, is effectively zero. A disciplined value investor just walks away from this one. Okay, part 3, the Lynch lens. Peter Lynch absolutely loves a good narrative, and he'd categorize 3D Systems as a classic turnaround intertwined with a cyclical industry. Now, we can't even calculate a PEG ratio here because historical and near-term earnings are completely negative. And the balance sheet, man, it's tenuous. That $85.1 million cash pile is eclipsed by $96 million in convertible debt. Plus, they've got a strict $20 million minimum cash covenant. This right here perfectly illustrates the danger of a turnaround. Just to survive, they initiated a massive public offering in June 2026, issuing over 16 million shares at $3.05. That heavily diluted existing institutional and retail owners. While posting a positive adjusted EBITDA of $2.1 million is an awesome early sign, that massive shareholder dilution tells us this turnaround just isn't self-funding quite yet. Lynch would likely tell us to hold off, just wait and see. His opinion would be a hold until the company proves it can manage its debt without continuously tapping equity markets and crushing its own shareholders. Next up, part 4, the Graham lens. Now we adopt the strictly mathematical, defensively pessimistic mindset of Benjamin Graham. Before we even run the numbers, just look at his famous intrinsic value formula. Notice that this entire equation relies completely on the assumption that the company is currently generating positive earnings. Running through Graham's defensive investor checklist is pretty brutal. Adequate size? Fails. A $428 million market cap is way too small for his safety standards. Strong financial condition? Borderline at best, considering the cash burn. Earning stability? Fails miserably with a negative EPS of 3 cents. Dividend record? Fails. There is no dividend. And while the price-to-book ratio technically passes at 1.81x, the PE is negative. Honestly, we have to be radically transparent here because GAAP EPS is negative. Graham's intrinsic value formula just throws a mathematical error. You literally cannot take the square root of a negative number. With absolutely zero historical earnings power to back it up, the margin of safety at the current price is exactly 0%. Graham just wouldn't touch this stock. His buy price is an absolute zero until they can prove they generate real, stable earnings. All right, part 5, DCF valuation models. Let's move into modern valuation. Free cash flow is the absolute lifeblood of a discounted cash flow model. It's the cash left over after operations and capital expenditures. But since 3D Systems currently has negative $7.2 million in operating cash flow, we can't use historical data. We have to project a highly speculative turnaround to fill this gap and forecast future cash flows. So let's build a base case DCF. Step 1, we assume free cash flow finally breaks even this year, in 2026. Step 2, we project 5 years out, scaling free cash flow up to $15 million by 2030, driven by that incredibly impressive 21% growth in healthcare. Step 3, apply a perpetual terminal growth rate of 2.5%. And step 4, we discount this using a high weighted average cost of capital, 10.5%, because this stock is highly volatile with a beta of 2.58. By explicitly making these assumptions to bridge the unprofitability gap, our model calculates a base case fair value of exactly $3.25 per share. Now check out this sensitivity matrix. DCF models are incredibly sensitive to your assumptions. If the discount rate inches up to 11.5%, fair value drops to $2.95. If terminal growth hits 3% and the risk drops to 9.5%, it spikes up to $3.80. This brilliantly illustrates how even the tiniest tweaks drastically swing the fair value, which really highlights just how speculative this investment actually is. Let's throw a couple more models at it. Looking at a comparable price-to-sales multiple, if we apply the industry median of 1.5x, we get a fair value of around $4.40. And if we run a reverse DCF, basically asking what cash flows the current $2.91 price implies, the answer is staggering. The market is currently pricing in zero to negative free cash flow forever. Basically, the current share price tells us the market is purely valuing the company's cash pile and patents, but heavily discounting them because of the fear of further shareholder dilution. Finally, part 6, synthesis and final verdict. It's time to bring all these disparate frameworks together. As you can see, the value purists, Buffett and Graham, rejected outright at $0. There's just no stable earnings. However, our speculative DCF model sees a base case of $3.25, and comparative models, along with analyst consensus, see potential upside caps somewhere around $4 to $4.40. This stark contrast is driven by an epic battle between key strengths and key risks. On one hand, we have incredible strengths, a stellar 21% growth in healthcare, achieving positive adjusted EBITDA of $2.1 million, and an 88% reduction in year-over-year net loss. The turnaround is actually working operationally. But on the flip side, the risks are dire. We're talking material weaknesses in controls, an oppressive $96 million debt overhang, and a terrifyingly fragile balance sheet that literally forces the company to dilute its own shareholders just to keep the lights on. So, blending all of these frameworks, our final recommendation is a definitive hold. If you're a strict value investor following Buffett or Graham, you steer completely clear until earnings turn sustainably positive, period. If you're a growth investor holding for the turnaround, you should only consider buying if the company proves it can service its debt and reach cash flow break-even without executing any more of those dilutive stock offerings. It's the ultimate turnaround gauntlet. They've got the tech, their healthcare division is thriving, but man, that financial clock is ticking very loudly. Will 3D Systems successfully outrun its debt overhang, or will shareholder dilution ultimately sink the ship? Only time will tell if they survive long enough to reap the rewards. What do you think? Keep these analytical frameworks in your back pocket the next time you're looking at a messy turnaround, and I'll see you in the next explainer.